Good evening, ladies and gentlemen. I'm Akash, moderator for the conference call. Welcome to Q3 9-month FY26 earnings conference call of Trishakti Industries Ltd. We have with us today Mr. Dhruv Jawar, the CEO of the company. As a reminder, all participants will be in listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone telephone. Please note that this conference is being recorded. I would now like to hand over the floor to Mr. Rishabh Rathod from Concall Partners. Thank you, and over to you, sir.
Thank you, and good day, ladies and gentlemen. My name is Rishabh Rathod from Concall Partners. We represent the IR for Trishakti Industries Ltd. I warmly welcome you all to Trishakti Industries Ltd. Q3 9-month FY26 earnings conference call. The company is represented by Dhruv Jawar, the CEO of the company. I would now like to hand over the call to Mr. Dhruv Jawar for his opening remarks. Thank you, and over to you, Dhruv.
Thank you, Rishabh. So, good afternoon, everyone. It is a pleasure to welcome you all to Trishakti Industries Ltd. Q3 9-month FY26 earnings conference call. I am pleased to welcome all our stakeholders, investors, and analysts as we review our recent performance and outline our strategic priorities going forward. The third quarter marked another strong milestone in our growth journey as we continue to build momentum. Our standalone revenues from operations stood at 8 crores, up 20% quarter-on-quarter and 357% year-on-year. Our EBITDA stood at 5.61 crores, reflecting a 43% growth quarter-on-quarter and a 369% growth year-on-year, driven by higher asset utilization, disciplined cost management, and strong execution across multiple projects. Our PAT also rose 53% quarter-on-quarter, 1,744% year-on-year to INR 2.45 crores, underscoring our ability to translate operational strength into sustained profitability. For the 9-month ended December 2025, our standalone revenues reached 18.74 crores, up by 37% year-on-year. Our EBITDA for 9-month FY26 stood at INR 12.23 crores, reflecting a robust 211% growth year-on-year, with margins at 65.27%. Our PAT for the 9-month period stood at 4.97 crores, up 183% year-on-year, demonstrating consistent profitability across the fiscal year. Based on our 9-month FY26 performance, our annualized revenue run rate now stands at 48 crores. Our heavy equipment hiring business remains the core growth engine, operating at 100% utilization. During this quarter, we have made exceptional progress on our 400 crore capex program planned through FY28, with 200 crores already spent. Our FY26 capex target was rupees 100 crores, and we are delighted to announce that we have already deployed 154 crores worth of machines year to date. Moving ahead, we are focusing on expanding our next generation higher tonnage fleet to support large-scale industrial and renewable projects. Our balance sheet remains robust, supported by prudent financial management and an efficient payback cycle of around 3 to 3.5 years for our equipment investments. With fleet size now standing at 117 machines and marquee clients including Larsen & Toubro, Reliance, Jindal Group, AC International, and ITD Cementation anchoring our order book, these relationships provide us with resilient revenue visibility and a sustainable growth runway. Looking ahead, Trishakti is well positioned to capture a larger share of India's infrastructure and renewable energy opportunities. We remain fully committed to delivering sustainable growth and long-term value for all our stakeholders. Thank you for your continued trust and confidence in Trishakti Industries Ltd. With that, I conclude my remarks and open the floor for questions. Thank you.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 1 again. Let us wait until the question queue assembles. Ladies and gentlemen, if you have any questions, please press star and one on your telephone keypad. Ladies and gentlemen, if you have any questions, please press star and one on your telephone keypad. The first question comes from Mr. Anshul Jain from Trishakti Industries. Please go ahead, sir.
Hi, good afternoon.
Yeah. Hi, good afternoon.
Hi, this is Anshul Jain from Trishakti Industries. I have three questions for you. Firstly, your ARR post 9 months, that is this 3 quarters, stands at about 48 crores. And your presentation shows revenue targets of 20 to 22 CR for FY26. And we are already at 3 quarters, which is about 18.73 crores. So, can we expect to significantly surpass this guidance? And secondly, revenues grow 20% quarter-on-quarter in Q3 versus 63% in Q2. So, why is this difference? What led to the slowdown? And can you help me with the order book as of date? That is correct. Thank you.
Yeah, sure. So, your first question was regarding the ARR, right? So, let me answer your first question first. So, yes, right now, since honestly, if you see our segmental assets also, it has reached 200 crores. So, for this year, we had guided that we'll be doing 100 crores in capex, but in the first 9 months itself, we have done 154 crores because the demand is extremely high right now. So, that is the reason why in the past 4 to 5 months, our fleet has literally quadrupled up. So, this is the reason why our ARR has gone up significantly. And of course, if we have created a 200 crore segmental assets in our books for heavy equipment hiring, then this is the reason why we will be surpassing our guidance for this financial year. Because last year, whatever guidance we had given was with respect to the 100 crores of capex. So since we have surpassed this capex projection, hence our revenue projections will also keep going up. So on a annualized basis, right now, in the first 9 months, we are at 48 crores of revenue annual 100. But in the last 1 week, we have won a few more orders. So this will significantly go up in the coming quarters also. And can you just repeat your second question regarding the revenue part?
Yes, revenues grew 20% in Q3 and 63% in Q2. So I just wanted to know, why is there the difference? What led to the slowdown in this?
Yeah, see, we are in a contractual business, right? So the amount of capex we have been doing, our lead time for the machines to start generating revenue is around 1.5 months. So if I'm doing capex today, then it takes 1 to 1.5 months for my machines to start generating revenue, because it does take time for our machines to reach the site, get the TPI done, logbook started, diesel book started, and there are many compliances. So that is the reason why whatever capex is being done in Q3, the real fruits we'll be getting it in Q4. So that is the reason why there is a lag there's a lead time from when we purchase the machines and when we start generating revenue from it. So I think this answers your question. And also, one more reason is that the asset base was quite low in Q2, and in Q3, our asset base has also jumped significantly higher. And if you see in our Q2 balance sheet, the X1 balance sheet, a lot of our machines were into CWIP. So those machines have also started generating revenue now in Q3, and purchase have now started generating revenue from the month of January itself. So I think this answers your question. And the third question you had on the order book side. So see, since it's a contractual business, we get 6 months orders, 12 months orders. But generally, before we actually take an order from a client, we have a full survey of the site where we make sure that the project should at least go on for the next 2 years or so. So although the current ARR is at 48 crores, as and when our contracts keep getting renewed, this ARR will also keep going up. So this is how our order book is actually placed.
Okay. Yeah, got it. Thank you for these insightful answers, and wishing the best to Trishakti Industries.
Thank you so much.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and one on your telephone keypad. The next question comes from Mr. Satya, an individual investor. Please go ahead, sir.
Hello. Hi, sir. Hope I'm audible.
Yeah, you're audible.
Congratulations on a good set of numbers, sir. And I'm relatively new to the company, so pardon me if the questions are a little basic, but just trying to understand it. So we are projecting, great growth, and I think we are also already delivering on a lot of it. But want to understand, how are we suddenly, getting this huge demand? Where is it coming from? And, our competitors are also getting such demand. I was looking at a couple of other, one listed player. Their growth is not as much. They're significantly bigger as well. But what's our story, sir, in terms of how are we getting this huge demand from?
Yeah. So let me give you a brief understanding about this. So in the last 6 months itself, we have seen that in the renewable energy segment, the demand is skyrocketing like anything. So be it in the solar part and the BESS plants as well. So recently we have got a lot of orders related to the BESS industry, the BESS industry, battery storage. So since a lot of new plants are coming up for those things, so that is the reason why they need a lot of heavy machineries in order to make those plants. So if the requirements are going up significantly in that industry, then technically even we are you can say that we are secondary benefiters of this thing. And a lot of new plants are also coming up, be it steel or be it anything. Recently, we had won an order for the bullet train project as well. So L&T is doing that project. So we have given a few machines over there as well. So if you technically see that all these demands are picking up on a very fast pace, and this is the reason why we could actually do a 150 plus crore capex this year when we were only projecting 100 crores. So this kind of demand came as a surprise for us as well. We were also not expecting that in H1, towards the end side of H1, we will be getting so much demand, and because demand side is more in the H2 part. Generally, December to March, we get a lot of demand, but this year, as I told you, since the renewable energy part is going up quite well, so this has given us a really good understanding that where our industry is heading.
Right. And sir, when you say renewables, you are referring to mostly wind, right? Or is it also includes other parts of renewables?
Yeah. No. So see, other companies might be into wind, I'm sure. We don't have any exposure in the wind energy segment. Because for wind energy, you need more than 750 ton and 900 ton plus machines. So right now, we feel that particular market segment does not have good yields, because the number of machines in those industries are going up significantly. And recently, the government had also raised a new rule that the average height of the windmill has been, suppose if it was 10 meters, then it has been moved to around 11 or 12 meters. So because of that, most of the 750 ton machines are now not usable for the wind energy segment. So we did not take that hit because we were not in the wind energy segment. And we are not even planning to get into the wind energy segment anytime soon, because the yields in that particular segment is not great right now.
So our renewables, sir, is mainly solar?
Yeah, it's mainly solar and the battery storage.
Got it. Sir, on this only, sir, one quick question follow-up on this is, we have a lot of great names in our client list. And, how did we sort of, what's our offering that such big names are coming to us in a short span of time, relatively short span of time, sir? What are we doing differently, sir? Just trying to understand that.
Yeah. So see, if you technically see, if I'll be very honest with you, we are into this industry since 1997. So we have always worked with the bigger companies. Now the thing is that we had given a press release last year regarding this thing, that we had a family separation where our side of the family had taken over this whole company in FY24. So then we had restructured the whole company, and now we are only focusing on it, this business, which is our core revenue generating business. So we have experience in heavy equipment hiring. So we have transformed the whole company into an infrastructure phase company. So
Right.
the point being is that we were always in links with L&T, Reliance. We were always their vendors. It's just that right now everything is being restructured. That's why it's looking like we are newcomers in this industry, but it's not like that. So because of
Got
this
it, sir.
reason why we were always vendors, it's just that we had to shift everything and get the whole company restructured in the last 2 years.
Got it. Sir, on the receivables front, the receivables are pretty high. And I was also comparing it with another competitor, but overall also our receivables seem to be on the higher side.
Yeah.
Any commentary on that? Is it expected to stabilize, and why is it so
Yeah.
high this year?
It is expected to stabilize. It's just that this financial year has been like a V-shaped demand cycle for us. So the whole point is that since we are adding so many machines, our projections was just, as I told you, on a 400 crore capex side. Even though 1.5 years is left, we are already done with more than half of the capex cycle. So because of that, the receivables are going up. But of course, as I told you, that the lead time is also there. So because of that particular lead time of 1.5 months, the receivables are still showing a lot. But over the next few quarters, you'll be able to see that it blends in quite well, when our top line also goes significantly higher. Like this quarter, we only did 8 crores of top line, but in the upcoming quarters, this top line shall go up because our monthly billings have significantly gone up. So once you match it with the top line on a yearly basis, I'm sure the blend will be able to judge better.
Got it. And one follow-up question, if I can continue, or I can fall back in the queue.
Absolutely, you can continue.
So it's more of a bookkeeping question, sir. In the balance sheet that we released in the September quarter, there is this large entry of non-current liability. So what do we include in that? Just want to understand that.
Yeah, so the non-current liability is actually the machines we purchase. So we have a very short moratorium period for that, right? So because of that, we purchase the machines on that particular with that particular logic behind it. So that is the reason why there is a spike in the non-current liabilities. But of course, when it comes to when you'll be seeing it on an annualized basis, you'll be able to see that it's again balanced out. As I told you that in H1 itself, right at the end of the H1, on the end side of H1, we did receive a lot of contracts. So just to make sure that the machines reach on time. So this is the reason why we had to make sure that the funding and all, before the funding, the machines had to reach the site. Because of this particular reason, there is a temporary upside in that, but it will obviously go down in the next few quarters.
Right. So, and in our the segmental revenue split that we give, there is a heavy equipment hiring line item, but there's also an others, which in September was a large about more than 1 crore, and right now it's a negative entry of 1.6. So what is that, sir?
Yeah. When we buy a lot of machines for the FOC part, the free of cost spares, we do get a lot of credit notes as well. So this is just a accounting entry of those credit notes entry. So suppose if you're receiving a machine worth 5 crores, then with that 5 crores of machine, we also get 10 lakhs of spares. So these spares are then utilized, right? So it's just an accounting entry for that because this is free of cost. So somebody has to pay for that thing, right, in the books. So it's just an entry thing. So that's why last quarter, whatever was done, it was offsetted to this quarter.
So the number that we should look at is the heavy equipment hiring line item, or we should look at the net of
No,
heavy equipment hiring and
only heavy equipment hiring, yeah. And in the next financial year, we'll move to a single revenue stream segment. So we'll just have one revenue stream that will be the heavy equipment side.
Got it, sir. Got it. Thank you so much. I'll fall back in the queue. Thank you.
Yeah, sure. Yeah.
Thank you, sir. The next question comes from Mr. Digant Bump from SVIP Capital. Please go ahead, sir.
Hi, sir. I congratulations on a great set of numbers, but my question's already been answered. It was about the segmental revenue, the others in results.
Yeah. We had a lot of questions with the previous thing, so of course.
So basically the loss that is being shown is basically the utilization of the free items that we received, right?
Yes. So it's like we had a lot of, see, if you are buying 150 crores of assets in just under 2 quarters, obviously that amount of free spares, it sums up to a massive amount, right? So it's just to offset that amount because it's actually a part of our heavy equipment segment only, but technically it is not. So because that is the reason why there was another line item we had to add, or else this is the only way to do it properly.
Okay. And the assets that are showing as 11.5 crores, that is what is still available, and that eventually will be shown as losses in the coming few quarters.
No. It will be used in the machines, right? So it's not a loss. It will be used as a capital.
Yeah, of course. Of course. Just for accounting terms, it will be shown as a loss. So.
Yeah. But we have utilized all our most of our FOCs. So I'll have to check what you're exactly implementing to once.
So in the same segmental wise revenue, assets, liabilities, results, if you see there is segment asset written. In that 3C is others, which mentions 11.43 crores.
Just a second.
Segment asset, segment liability.
Oh, yeah. That's right. Yeah. So if you see that on a 200 crore block, we have received a lot of FOCs and all these things. So it's just an asset adjustment thing. Yeah. So it won't reflect as exactly losses because it will be adjusted with our heavy equipment hiring income, right? Yeah.
Right.
That's why it's in the segmental thing. Yeah. And not in the others, other income thing. Yeah.
Okay, sure.
Yeah.
Sure, thanks.
Thank you, sir. The next questions come from Mr. Rishabh Malik from Artha Advisories. Please go ahead.
Yeah. Hi. Actually, I just started looking at this company and I wanted to understand, as I'm seeing that we have industry leading margins right now compared to our peers. So I wanted to understand what are we doing differently and what is there anything like is our equipment better or what is it? Will it be sustained? Like will these margins be sustainable in the future?
Yeah. So, see, the major part is that why we are clocking 70% EBITDA margin. The major reason is that we don't have to pay for any kind of maintenance for the first 3 years because it's covered by the OEMs only. So that is the reason why we don't take an additional 5% hit, which most of our competitors are taking. So this is the major reason why we are clocking the 65 to 70% range. But eventually, post 3-4 years, when the maintenance also kicks in, then all these when we'll be gaining around 60 to 65% EBITDA margins.
Right. And the next question is, I wanted to understand the split between our source of funding, like how much is it through internal accruals and through debt funding, the capex amount.
Most of it is from the internal accruals. We are extremely cash flow positive right now. Because of having positive operating cash flow, that is the reason why we can reinvest in the machines. When we buy machines, we buy machines at 100% LTV, either a 3-year funding or a 4-year funding. Our repayments are also quite fast. We have raised 2 equity rounds as well past 1.5 years. Because of those.
Hello.
Because with these cash flows, we are able to buy even more machines.
Right. And the last question is, I wanted to know that what's our longest order book as of moment? What the long duration order book? What's like? Can you give some update with that or any details?
See, our first ever machine which we purchased was for on this particular after the restructuring of the company. We had given that machine in Jindal. It has been 2 years already. That machine is still running over there only. Technically 2 years is the longest order, the longest work order we have had till now. Whatever contracts we have recently entered, all are 12 months and above contracts, and we strongly feel that we have entered in the phase 1 of these particular projects, and there are still 3 more phases to go after this. We do see that there is good revenue visibility for the next 2 or 3 years. Because until these projects are made, these projects are finished, our machines will not be leaving the sites.
As of today, what's the amount of future order book that you have received?
We have received around 48 crores worth of orders on the 9-month balance sheet, P&L point of view. Till 31st December, our net order book stands at 48 crores. Recently, in the past 1 or 2 weeks, we have received a few more contracts as well. We are currently, if you are talking about today, then we are at around 55 to 56 crores.
And what is the execution timeline we are looking at for this order book?
For this particular order book, we have already started the execution. All the machines are at 100% utilization as of now. Our last set of machines, which were the 110-ton machines and the 150-ton machines, have also been started on 10th of January. Around 10th of January. Right now, since we are talking, we are at full capacity right now.
11 to 15 months, can you give any guidance on the timeline?
Yeah. From December this year to last year to December this financial year, we'll be clocking 48 crores of revenue. If you take 55 crores of revenue, even if you stop expanding right now.
Okay. That'll be all from my side.
In these calendar months. Yeah.
Yeah. Okay. Thank you so much.
Sure.
Thank you, sir. The next question comes from Mr. Yash Tanna from iThought PMS. Please go ahead, sir.
Yeah. Hi. I'm also new to the company, and I think my questions have been answered. It is regarding the funding of the CapEx. I think you mentioned that you've done more than half of the budgeted 400 crores CapEx. Again, I think I missed the part where you mentioned how have you funded that half and how are you planning to fund the other half from the internal accruals? And if you can also mention the 9-month FY26 cash flow that you've generated.
Yeah. Can you please repeat the last part of the question?
The cash flow or 9-month cash flow that you have generated.
Yeah. See, as I told you that we are currently generating good amount of cash flow. Answering this question of the 200 crores of CapEx we have done. As I had mentioned earlier that we have raised 2 rounds of equity, which has helped us to buy more and more machines and to mobilize the 200 crores worth of machines. After this, whatever the machines have been deployed, we are gaining good cash flow from them. Our internal accruals are quite nice right now. With this particular internal accruals on a monthly basis, whatever cash we are generating, we reinvest that cash into buying new machines. This is how organically we are slowly and steadily growing our asset base.
Okay, got it. And if you can mention the 9-month cash flow number, if possible.
9-month cash flow numbers, we will have to check. We can connect offline once, because 9 months we have not given the balance sheet. So for that, I'll take some time to check the books and get back to you. You can talk to Rishabh from Confide, and we can connect after the call maybe.
Sure. And the other question that I had, sir, so right now, currently you mentioned that we have orders, the order book is close to 50 crore plus, and the orders are for a timeline of 12 months, and the utilizations are full. I wanted to, ask you what happens or what is the risk of non-utilization of all these machines that you are buying, right? Because we are doing a huge capex and expansion, and we are giving out the machines. But is there any clause wherein the customer can sort of give the machine back or cancel the contract? So what is that risk of non-utilization in the business, if at all?
Yeah. So see, the customer can dehire our machines, but if they dehire our machines, they have to give us a 30-day grace period. And post this grace period, they'll also have to pay for the one side of the mobilization of the machines. So technically, this is a huge chunk of money, because, for example, if I'm renting out a 260-ton machine, so hypothetically, I'm saying that if I'm generating 15 lakhs of income on a monthly basis from a 260-ton machine, then if the contract during the tenure is dehired, if we get dehired, then first of all, we'll be needing a 30-day grace period. So that's equivalent to a 15 lakh additional income. Plus the mobilization of that machine will cost, if from Chennai to Gujarat, if I want to transport that one machine, the mobilization cost on one side is around 20-25 lakhs. So we'll be getting that as well. So this is the major reason why generally nobody gets dehired very easily unless you are doing a bad job. So this is a very big reason. And till now, whatever machines in whichever sites we are given, most of the machines are still running because the projects are not even close to the finishing part. So that is the reason why we have good clarity on the revenue side.
Got it. And so, one last question. So I didn't perfectly get, so I think you have some understanding with the OEMs where you don't have to pay them for a couple of 2 or 3 years, and then you have to make the payment. So if you can just help me understand what the exact terms of the contract are with the OEM.
No, these are all normal fundings. So these are all part of CVC fundings. It's just that if, for example, if I'm if you're getting 100 crore order from maybe Reliance, then to mobilize 100 crores worth of machines, it is not easy, right? To get 100 crores of debt at a single go. So this is the reason why we do get some small moratoriums from the OEMs as well for the smooth operational part. So it's not that we get such lucrative deals also, but it's just that we make sure that we do, as soon as the machines have reached the site, we start repaying them in terms of long-term borrowings only, which is the CVC funding for the banks.
Okay. All right. Got it. Thanks and good luck.
Thank you.
Thank you, sir. The next question comes from Mr. Manish Jeshwan, an individual investor. Please go ahead, sir.
Yeah, hi sir. Very good set of number. I am getting your company from last 1 year, and I have to say, जो आपने बोला है मतलब आपने किया हुआ है. तो सर मेरा बस एक और क्वेश्चन है कि FY27 का आपने गाइडेंस दिया था कि मतलब 60 करोड़ से लेके 65 करोड़ आप रेवेन्यू कर लोगे, तो क्या अचीवेबल है अभी राइट नाउ देखते हुए जो आप कैपेक्स कर रहे हो?
Yes. So हमारा जो 50-55 crores का जो order book है आज के डेट, so if you just do the math on the basis of that, this order book will keep on going down as well and up as well on a very fast basis, because these are contracts, right? For example, if a 250-ton machine contract is expiring in February, So technically speaking, I just have a 30 lakh contract left. But if it gets extended another 12 months, then I'm again good with a 2 crore order, right? So because of that, we are currently at our current pace. We are very confident that we should surpass that number as well. Because this financial year, if you've seen the first 3 quarters itself, we have done almost 19 crores of revenue, and our guided revenue was 20 to 22 crores. And
Yes.
now we are at peak capacity. So this year we will be surpassing by a good percentage. So this will help us to get closer to our FY28 revenue targets.
Okay.
Because
Thank
right
you.
now,
And
even if we stop expanding, we should be doing 55 crores of revenue for sure with our current order
okay,
book.
very nice. Very nice, very nice.
Yeah.
And sir, your PAT margin will be in, मतलब जो PAT margin आपका क्या इसी के रेंज में रहेगा स्टेबल 30% के अराउंड में?
It will be anywhere between 25% to 30% because in the first 2 years, we get good amount of depreciation because the machines are
Okay.
absolutely brand new. But eventually, in the next 3 to 4 years, when we do have to pay taxes on the income tax side, then this PAT margin will slightly go down, but it's not a big thing because we will be churning our machines and we will be buying more machines as well. So for the next 3-4 years, this 25-30% margin should always be stabilized. See, if you're going on expanding and if you have that hunger that on a 400 crore capex, so we have just said, but if the demand is more, then why can't we do 1,000 crore capex also? So if you are going on buying machines every year, then the depreciation benefit is also a lot. So we don't have to pay a lot of taxes as well. So जब तक ये हो रहा है, तब तक we can make sure that our PAT margins will always be in a similar range.
ओके, वेरी नाइस. तो सर क्या आप मतलब अपना कैपेक्स का गाइडेंस इंक्रीज करोगे? जो आपका 400 करोड़ का ओवरऑल गाइडेंस था, तो वे तो आप ऑलरेडी हाफ भी पहुंच चुके हो, तो फिर क्या आप उसको और एक्सटेंड करोगे गाइडेंस टर्म में FY27 के एंड तक में, लाइक दैट समथिंग?
See, my target is that let's reach the 400 number first. See, investors
Okay.
like clarity, right? You all love clarity. It's not that I can say anything I want, right? And that will be part of guidance. But it's always better to be practical. Right now, with our company's size, we feel that 400 crores of capex is somewhere where we can reach organically. If we announce a 1,000 crore capex journey, which the demand is there, but obviously for the banks and all to give us more and more limits, it takes time, right? So because of that, 400 to 500 is a genuine number. We feel that with the current internal approvals, we can easily reach there. Now, in order to go to 1,000 crores, then we'll be needing further internal approvals, and the demand should also be like that. So that's why we don't want to overcommit anything. Of course, once we are done with the 400 crore capex, it's not that we are just going to sit and relax, right? We will be doing more and more capex as well, right?
ओके. तो सर क्या आप अपना लास्ट क्वेश्चन है, क्या ये जो FY28 का आपका रेवेन्यू गाइडेंस है 100 करोड़ के करीब में, तो क्या आप उससे भी ज्यादा कर सकते हो, राइट? आई थिंक तब तो उसके हिसाब से, क्योंकि आपका कैपेक्स भी फुल मतलब चल ही रहा है अच्छे तरीके से, और आपके पास ऑर्डर्स वगैरह आ भी रहे हैं बड़े बड़े कंपनी से, तो फिर मैं तो ये मान के चलूंगा ना राइट नाउ कि आप 100 करोड़ से ज्यादा ही अचीव कर लोगे, आई थिंक, राइट? FY28 तक में with the PAT margin of around 25 to 30%.
Yes. We genuinely feel that there is a very high chance because of the kind of demand we are seeing right now. But we don't want to commit to anything. But with our current order book, we are already 55-60% there, and it's literally 2 years बाद का बात है ये. So we are on a good track. We don't want to overcommit anything, but we are very strongly, well, we feel that in FY27, see, if we are able to generate more demand before the upcoming monsoons, then it is going to be a very good thing for us. Because if we are able to make sure that we can do another 100 crores of capex, if we are getting that demand in the next 6 months only, then these machines, when a 300-400 crore job starts generating revenue and positive cash flow, then the real thing starts happening. So right now, if you see, our 200 crore block has now started generating full, it is at full utilization. So maybe in the next few quarters, you'll get more clarity on where our top line is going to go. But yes, if we get one or two more projects, like जैसे मिला है अभी recently, if we are able to get those kind of projects, then 100% we can try to surpass that.
Okay. Thank you, and all the best. All the best. Thank you, sir.
Thank you so much. Thank you.
Thank you, sir. The next question is a follow-up question from Mr. Satya, an individual investor. Please go ahead, sir.
Hello. Hi, sir. Thank you for the follow-up.
Yeah.
Sir, in steady state, what will be our asset turn like?
We want our asset turn to be very low because when we send a machine to a plant, so we want it to be there till जितना time रहे. मतलब because for us to keep churning that, it's not a good thing because if the machine is going from like Chennai to Gujarat, then it takes 12 to 15 days. So if we keep churning our machines a lot and we get shorter term contracts, then that additional 15-20 days of revenue will we'll start taking hit in that.
Right.
So we would love it if our machines are working in the same plant for the 3 years, 4 years, 5 years, 6 years.
No, but sir, I'll ask you differently. Sir, I want to understand कि अगर अपना 100 crore का asset है, तो how much revenue can it generate in a year?
Oh, that way. Yeah. So see, it depends on different kinds of assets. Okay, if you are purchasing the smaller machines like if it are under 100 tons, then the top line in those machines is more because the operational cost is also more. So the net blended yield will come similar only. But for example, if I'm buying a higher tonnage machine like a 250 ton, 500 ton machine, then the revenue that machine will be generating and the cost of operating those higher tonnage machines is very low. So to be on the safer side, on a lower tonnage machines, we can generate up to 3%, 2.8, 3%. With overtime, we can also go to 3.5% of net revenue. But in the higher tonnage machines, our net revenue will be 2.5% only. But the operational cost in those machines will just be 0.2% or 0.3%. So our net blended yield will be similar in both the cases.
So this yield is annual, sir? I didn't understand this. Yield you are saying is annualized or
it's a monthly basis. Sorry, I didn't mention that. It's a monthly basis. 3%, 2.5%, what I'm saying is on a monthly basis. Yeah.
Right. Got it. So about 30-35% on an annual basis.
Yes.
Got it.
And see, in X2, we get a lot of overtimes, like massive amount of overtime. So we can generate 10-20% more yields as well. Like if the yields are 30% per annum, and we can, in some years, we can generate 36% also. Like being on a hypothetical situation, I'm saying. If the yield are 40%, then it can go up to 48% also. Yeah.
All right. Got it. Sir, what's our client concentration like generally of the revenue and maybe based on the order book that you have? Is it concentrated in a few clients or how is it spread?
Yeah. See, we have a business mantra that we do not work with the local subcontractors. Because honestly, if I tell you the real truth behind everything, if I'm working with a chip companies like Tata, Jindal, Reliance and all, I can always get their bills discounted if I'm in any kind of cash crunch in the future, right? We don't have any kind of working capital limit. We just have on a 200 crore asset base also, we are organically growing. We just have a 2 crore bank limit, like a OD facility. So right now we are organically growing because we are cash flow positive. But if we start working with the subcontractors, the local subcontractors, their payment will start hitting our accounts in next 5 months, 6 months, because that's the aging cycle for them. So cash management becomes really difficult if you are working with those companies. So that is the reason why there is a concentration, but only in the blue chip companies. Even in the blue chip companies, there is some concentration because not all the companies keep doing capex together, right? Some companies will do capex this year. some will be at a finishing stage this year. Some companies will start doing CapEx next year. So we have to make sure that whichever company is doing CapEx, we are actually behind them and working with them. So maybe on a 3-month basis or a 6-month basis, maybe our order book can come from like 30 to 40%. 40% of our order book can come from one company also. But that is just a thing that one project has just started. As soon as other companies also keep giving us more contracts, that blend is always there. That pie chart will always be like diversified. But in the short term, it can be concentrated. But in the longer term, maybe if you take a 12-month thing, then it will get blended again.
Right. Got it. So do we have any regional focus, or we are available pan-India?
We are available pan-India. We are working in almost like everywhere. In the east, we have lesser machines, except in Odisha. We don't have any exposure in the east, but we are working on a pan-India basis.
Got it. Thank you, sir. I'll fall back with you.
Thank you, sir. We have another follow-up question from Mr. Rishabh Malik from Artha Advisories. Please go ahead, sir.
Hi, sir. You earlier mentioned the point about higher depreciation that you get the benefit of in the first 2 years. I just wanted to clarify my understanding. Please correct me if I'm wrong, but is that also coupled with the GST benefit that would kick in because of the high capex that we are doing? So, the input credit that we can avail, and in turn, our cash flows would look better for the first couple of years. Is that understanding correct?
Yeah. So when we buy the machines, we buy it in GST billings itself. So of course, in the first 4 years, 3 years, we do get our GST back. But in the revenue top line everywhere, we do not take GST because we do not capitalize that. So technically, if you're saying if I'm doing a 10 crore revenue, I'm actually getting paid 11.8 crores because GST is not shown in our revenue. But if you see, GST is being blocked, right? So like the GST money, so it should be considered in the capex side. So when you do a deep dive into our books, then you'll understand this better. And on the depreciation part, as I told you that we use the SLM method. We do not use the written down one. So in the income tax, we do get 15% depreciation benefit. And in the books, on 100 tons and above, we get 4.75% of depreciation. And on 100 tons and below, it's a 6.33% depreciation.
Got it. Just a quick question there. Just for example, if you can explain, let us say, you've done 100 crore capex. I'm assuming the GST should be around 28 odd %. Correct me if I'm wrong. Now, what I'm assuming is that, in order to pick up a new business that you're doing, it becomes beneficial for you because your actual equipment cost becomes 70 odd crores. And your yield would immediately spike up for that particular year until you get the benefit. Once the GST benefit is done, then the margins will come back, or the cash flow initially should ideally look higher because this is ideally going to be a non-cash entry.
Yeah, absolutely right. But it's for those companies who are not wanting to grow after a certain point, right? If after 4 years, if my GST input is being claimed by me and I'm stopping the capex cycle permanently, that I'm told that I will not do any capex, then it makes sense, right? But if you're growing by more than 18% after 4 years, like this is after 4 years, even in 1 year, like for example, I'll tell you, if my payback cycle is, suppose hypothetically is 4 years, then after 4 years, I will be needing at least 18% of my new capex to be done so that GST benefit comes into me. So post that, if I'm selling out a machine and buying newer machines, then that offsets it. Right? Or I can buy more machines so that I can get more GST input as well.
Right.
So it's all about how you manage it. It's like capital allocation, that how you manage your fleet in such a way, burning cash, rather you are generating cash. You have to be very practical enough with that.
This was a very good point, sir. Just one more follow-up question there. So, is it fair to assume that you would depreciate the machines in the first 4 to 5 years?
See, on the income tax, we depreciate machines in 7 years. But in the balance sheet, we depreciate machines over 22 years. It's around 20 years.
Okay.
Yeah.
And actual replacement cycle for you would be, let us say if you invested in a new machine today, you would actually replace it 10 years down the line, or how many years down the line? I'll tell you my school of thought. I'm thinking about, you replacing your machine. So, again, churning cash from selling old equipment, again buying new equipment, getting GST, getting a better depreciation, which again pumps your cash flows, increases your margins as well, because it's easier for you to secure business at a more competitive rate, I believe.
This is what we are doing, right? So this is exactly what we are planning. So we see now. Another thing, technically I shouldn't say SE, but if you technically see that every 7 years there is a spike in the metal prices, like the metal industry goes insane, right? So if you time your exit on those years, then you can get a good 10% extra premium for the machines, because our machines are literally metal. It's just an engine, hydraulics, and then it's only metal. So if you just have to be creative, right? It's like if you're very creative, you can actually generate more ROI as well. It's not only for the books, right? Fundamentally, you have to make sure that your asset is being utilized to its max potential. If you go from the 20-year, 30-year-old school thoughts that whatever machines I have, I'll just keep it like that. Let it go to zero value, let it be done like that. So if your thoughts are like the old generation thoughts, then obviously capital management will be very difficult for you. Because although you'll think that you are generating good cash, but you're actually not generating good cash. So that's how I see it.
Thank you so much. Thank you so much, sir. That will be all from.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on the telephone keypad. I repeat, if you have any questions, please press star and 1 on the telephone keypad. We have next question from Mr. Jayesh Shah from Shah Investments. Please go ahead, sir.
Yeah. Hello.
Yeah.
Hello. Hi. Hi. So congratulations on a very good set of numbers. I just have a couple of questions from my end. So firstly, your fleet is split heavily concentrated in the energy sector. So how confident will you be about the longevity of the contract? And are adding fleet as per this sector a requirement? Hello?
Yeah. So you're asking one question or two questions? I couldn't get
Only one. It's one question. How long will be the... Yeah.
So, see, we are extremely bullish on the renewable energy side because that segment is growing very fast, like very, very fast. Even the metro side is growing really fast, but the projects are still yet to open. A few of the biggest EPC contractors have just won the orders, so it will take around 2 to 3 more months for the civil work to be done, and then they will get the crane and manufacturer requirements. So we are just waiting for those particular things. Now, if you technically see, we like on the renewable energy side, if you see on a pie chart basis, right now we are at 45% exposure to the renewable energy side. But eventually, when we start doing more and more capex in other industries as well, and new projects keep opening up, then this blend will obviously come down. Right now, our asset base is around 200 crores. That is the reason why around 80-90 crores worth of machines are into the renewable energy side. But if you see on the longer term picture, if suppose on a 400 crore block, if you've got 120 crore machines in this sector, then it's just 30%. So right now we are getting more and more demand from this segment, so we are concentrating on this. But it's not that we have stopped looking at all other segments. As and when more and more demand comes from the other segments, we'll surely shift to those segments as well. I hope this answers the question.
Yeah. And one more question. So Reliance entry in the renewables is a very big win. So can you share the contract size, duration, and whether this can open the door for other projects than Reliance?
Yeah, so Reliance is one of our biggest vendors and biggest clients. But yes, Reliance getting into renewable energy has been a really good thing for us. So if they keep expanding into the renewable energy segment or any refinery segment or anything, since we are vendors of Reliance, we do get requirements for all these things. So it's not that Reliance is only doing renewable energy. They have other things as well. They are into chemicals. They are building India's biggest chemical vinyl plant as well. So it's just that if you are vendors with them, so you will keep getting work for everything. But yeah, if they are doubling down on any particular sector, then it's a really good thing for us because the machinery requirements are in all sectors, be it solar, be it renewable, be it metros, be it steel, anything.
So this answers my question. So, thanks, Dhruvji, and all the best to you guys for the coming quarters.
Thank you so much.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, if you have any questions, please press star and 1 on your telephone keypad. Since we have no more questions, we may now conclude the call, and I now hand over the call to the management for the closing remarks.
Yeah, hi, sorry, phone was on mute. Thank you everyone for joining our Concall today. I really appreciate you all taking out so much time to listen to us. And it's been a great journey till now, and we hope to achieve even bigger milestones in the coming quarters. Thank you so much, everyone. Yeah, thank you.
Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Dusabas conference call service. You may disconnect your lines now. Thank you and have a pleasant evening.